Hello and welcome viewers. We have Nirmal Bank who's released their Commodities and Forex Yearbook 2020. In fact, we have Kunal Shah, Head of Commodities Research, joining us, who is the author of this book. Kunal, the title says Winds of Change. What does this actually mean?
Yes, winds of change is basically in the traditional economies, demand and supply used to be the main driver of commodity prices. But this year, in the year 2019, we've seen gold prices rallied by 30-35%, and the jewelry demand in India and China is down by more than 40%. So the things are changing more than the traditional factors which are driving the commodity prices or the other asset prices. The new factor, which is basically liquidity, the central bankers, the role they are playing in order to prevent any downside in any asset classes, the way they are printing liquidity. So basically things have changed, and that is the theme of our yearbook.
So the change that we are talking about, is this a global phenomenon right now, or it's only India centric?
It's a global phenomenon, and it's not just India centric. Across the world, what has been happening from last 10 years, central bankers are pumping liquidity and trying to prop up the economy. 2018 was the first year where we've seen a sustainable recovery, and after that followed by 2019, where they thought that the economies are weakening, especially US, and we've seen all the central bankers which were on the verge of increasing the interest rate. They started all decreasing the rate. They started to came up with the easy monetary policy, stimulus packages, and massive amount of liquidity is being infused in last 6 months across the globe. So this kind of monetary easing is not seen historically. I think not even in 2008. We are, so just to give a perspective, we are talking about India's economy going to become from $2 trillion economy to $5 trillion economy in say next 5 years. But what has happened is, in last 1 year, the debt of the central banks, the global central banks, have moved up by $5 trillion. Can you imagine that the magnitude of money which is coming in?
Correct.
So India, world's fifth largest economy, it is going to take for us 4 to 5 years to reach from $2 trillion economy to $5 trillion economy. And in 2019 itself, $5 trillion of debt accumulated by the global central bankers on their balance sheet.
Right.
So this is the kind of magnitude of the change which is going on in the world, and people are not acknowledging. So I believe that more than the fundamental strength, most of the assets are rallying with the expectation of this kind of monetary printing will continue. So economic reality remains pretty grim.
Correct.
And the liquidity scenario remains pretty easy.
Right, so we are trying to say that the global liquidity is something which will remain pretty strong going ahead.
Yes.
You have any which ways central banks, global central banks who are coming in cutting interest rates right now.
Yes.
And the pace that they've adopted right now, they are printing money at a record pace, and this is going to continue.
Yes, absolutely. So that is remaining the main factor in determining the outlook of a lot of assets.
Right.
But how long?
Right. So if you have to talk about IMF also right now, what is the kind of global GDP growth forecast that they are giving out, and what does that really then mean for the economy?
Well, last year IMF predicted the global economy will grow at 2.9%. This year they have revised that up from 2.9 to 3.3, but they've revised the amount of GDP growth percentage. So, but I think after that there is a recent coronavirus crisis in China. So I believe that the global GDP will still grow, because when there are some weak pockets, there are also strong pockets. The emerging markets are doing well. The developed markets are not doing great. So I think it's a mixed pocket right now. So IMF forecast is not very bearish, but at the same time, the impact of whatever is going on in China from last 2 months will definitely have some negative impact on the global GDP growth, at least for the first half of the year.
So for China, if you have to talk about their economic data as well, are we expecting somewhat of bearishness on the back of coronavirus, which in turn could have an impact on India?
Yeah, so not on India, But because of the coronavirus, the Chinese GDP growth forecast, which was 6% forecasted by IMF, I think, and that should go down 5.5% or perhaps 5.3%. Chinese central bankers will try to prevent sharp downside in economy with the innovative tools which they have been using. But at the same time, I think first half is definitely going to be a drag on their economy because economic activity have halted, and I think scenario is not going to improve immediately.
Okay, so what is the kind of difference that you're seeing in terms of the economic reality globally versus what we are seeing in terms of what's happening in global markets as well as India right now? Is there a major divergence?
Yeah, it's a great question. If you look at what's happening with Europe, okay, first I'll talk about Europe. So Germany, it basically last year came up with a negligible GDP growth, and I remember in 2017 in first quarter Germany's GDP growth was say 1.5%, 1.2, 1.3%, which has dropped to almost 0.1%. So technically speaking, if it continues like that, Germany will fall into recession. But DAX is making new high. So US manufacturing index in 2018 was 60. Right now it is at 50. It is dipped to 48, and Dow Jones is making new high.
Nice, correct.
So there has been a major divergence across the globe, economic reality versus the markets. So markets are rallying because central bank doesn't want markets to go down.
Correct.
And on other front, the economic situation in the developed world, US, Japan, Europe continues to remain grim. In China, there has been a debt restructuring going on with the state-owned enterprises. They cannot stimulate the economy the way they used to. So the growth expectations are muted. I don't know how long this liquidity is going to continue.
And similar is the situation in India as well right now?
Exactly. So we are in a scenario where everyone needs a hedge. So this monetary experiment which central banks are doing, what if they are not able to stimulate growth in spite of so much liquidity being printed?
Correct.
So if the growth is not returning, then what they are going to do? So that's why gold and precious metal remains core investment, strategic investment for next 3, 4, 5 years.
So overall what we are talking about right now is that again it's the precious metals where the investments are going to come in. But if you see the current scenario, we very rarely see markets and gold move in tandem. This is after very long we are seeing this kind of a scenario. If you could just help us understand that bit.
Yeah, it's the last time it happened for a sustainable period was during 2006-2007 when gold and silver and equity markets were rallying together, and after that we had a subprime crisis in US. So this kind of phenomenon is just there is so much money floating. So it's like in a sea of liquidity, everything is floating. So all assets are rallying together, may it be bonds, may it be gold, may it be equities. So everything is rallying together. So at some point, if the growth doesn't come, that's where the problem starts. So at that time, gold can rise exponentially. But if the growth comes, then the downside in gold is also very limited because the central bank's debt is not going to go down. They are continuously expanding their debt. So it's a win-win scenario. In a scenario where the growth resumes and starts coming back, you can see a correction in gold, but gold will not crash.
So are you saying it's one of the strategic investment from
Absolutely.
a longer term perspective right now?
Yes.
And is it gold and silver?
Yeah, both.
Okay. If you have to talk from the trading perspective as well, are you seeing speculators also building any short positions in spite of this bullish trend? Or even that's not a phenomenon?
If you analyze the CFTC positions, you can clearly feel that the way prices are rising, more and more people are getting tempted to go short. Because the fact is that the actual demand, the consumption remains very weak. But to all the viewers who are watching this video, I would like to tell you, in 2018, the global ETF holding was roughly say 70 tons, which soared in 2019 to more than 400 tons. And I believe this year it can even surpass 400 tons and maybe 500 to 550 tons. So on one hand, people are looking at the actual demand, but the fact is the new demand has come. The new demand is coming from the ETF sector and the central bankers. Central banks on an average used to buy 300, 350 tons of gold. Right now they are buying 700 tons of gold. So forget about the weakness in the retail jewelry segment. Focus on the investment and what central bankers
So
are doing.
I think for gold and silver, at least as precious metals, it's moving more as an investment bet versus
Absolutely.
a consumption bet right now.
Absolutely.
Moving away from that, what's the view that you have right now, especially in terms of crude? Because we are not seeing that uptick that's coming in terms of crude prices. It's constantly staying in that range. What's your outlook?
Okay, in the last quarter of 2019, oil was in a deficit of say 0.25 million barrels per day. That scenario is going to remain there. The thing is that what has happened and what has changed in the oil market is the OPEC production. In 2017-18, OPEC production reached to hover around 32 to 33 million barrels per day, which has dropped to 30 million barrels per day almost. And at the same time, the US oil production has moved up from 9.5 million barrels to 12 million barrels a day. So on one side, OPEC is cutting the production and US's production is increasing. Mainly from the Permian Basin. So this basin, this year we expect that the production growth is likely to slow down after the humongous years of massive production which has come from this basin. So we are expecting even this year further 0.4 to 0.5 million barrels of growth in the US production. Hence, by the last quarter of 2020, oil market should be in the surplus of 0.4 to 0.5. So I don't think so that any spikes due to geopolitical tensions or anything they are not going to be sustainable.
So there is longer term outlook remains bearish.
Yeah, all the rise you see, Brent 65, 62 dollars is
sell on rally is the kind of
and
strategy.
Downside should be protected to the tune of $50, $48. It should not go below that.
But do you think it should not go below that $50, $52
yes,
per barrel?
Yes.
Right. So moving away from crude as well, another aspect from this that we're picking up is in terms of where base metals go. Now again, on the back of coronavirus, a lot of gyrations that have come in terms of metal prices. China being the hub, the hit that we've seen in the auto space as well, that's something which is having an impact on metal prices. What's the outlook from a longer term perspective on base metals?
Interestingly, apart from the coronavirus, one more thing which is going to decide the fate of the metals, the phase 2 and phase 3 of the US-China deal. The phase 1 deal has already taken place. So with the combination of these two factors, I believe it is going to be very difficult for base metal to rally significantly until and unless there are signs. So first quarter of 2020, we are going to see weakness because there is a glut which is getting created on account of this crisis in China, coronavirus crisis in China. So I do not expect any major recovery, but the moment things stabilizes over there and there is a progress in the deal, second and third quarter there can be a cyclical recovery in the prices of base metals. But if the US economy or the European economy or the Chinese economy doesn't show strength after infusing so much liquidity, I think again slowly they will start going down. So the theme is first quarter of 2020 weak, stability, recovery, but won't be able to sustain in the end.
Right. But any recommendation if you have to look at copper, aluminium, nickel, zinc and lead, which is the best placed?
Copper, nickel looks very attractive. Whenever you see a downside, whenever you see copper around 5500, 5600 on LME, good buying opportunity. Same way nickel around 11,500 to $11,000, good opportunity to go long. And from the demand side, nickel is the only metal which is going to show demand growth of 2.5-3%. Copper maybe 1.8 2% demand growth. Rest of the metals, the demand growth looks pretty muted.
Right, so that's how it is in terms of base metals. And very lastly, if you have to talk about the dollar rupee pair as well right now, clearly we are seeing that again, we are holding to that support of around 70 on the dollar rupee pair. Now, what is the kind of estimation do you see if you have to look at fiscal year 21? Because clearly the fiscal deficit is something which is taken into consideration over here.
Yeah, so the fiscal deficit this year is going to be the key factor, which is definitely going to put a lot of pressure on USD-INR pair. But at the same time, we believe that second half is going to be very friendly for the USD-INR pair because if the disinvestment plan by government takes place, so that will reduce the pressure on the fiscal front, and we believe that there is a strong chance of that happening. And the second is we are expecting US dollar to ease. We are expecting a correction in US dollar index. So we're expecting dollar index to crash and go down maybe from 99.50 to 96, 95.50 during the second half of the year, and that should relate into strength in the other emerging market currencies. So I believe that yes, second half looks bright for the USD INR pair, and you may see 70, 10, 20 kind of levels on the Indian bourses. But for significant strength, we need more evidence from the government, what they are doing and how they are going to manage the
right, so government policies
yeah.
will be more crucial as well. Thanks, Kunal, for joining us.
My pleasure.
So that's a roundup of the commodities and forex yearbook for 2020 from Nirmal Bang. Thanks for watching.